Hello and welcome. My name is Jamie Upson, and I'm the President and CEO of Stonehearth Capital Management, which has been my home now for the last 17 years. Boy, oh boy, who would have thought that talking about nursing homes would be so popular? We have about 4 times more participants today than we normally have. For those guests who are joining us, who are not familiar with our firm, I just want to let you know that give you a little bit of background. We've been here in Massachusetts for the past 35 years helping families. Most of those families are in Massachusetts, but we do have clients in 27 other states. We're helping those families pursue their goals through financial planning and asset management services. If you're interested in finding out more about our services or requesting a free consultation, then you can just give our office a call. So last night, I was brushing up on the materials that I'm about to present, and my 12-year-old came up and snuggled next to me and said, "What you doing, Dad?" And I told her I was preparing for a presentation today, and she asked me what it was about. I read her the title, and she said, "Never mind." I am certainly glad that we've got an audience today of people that want to hear about today's subject. On our website, which hopefully you can see right now, you'll see some past and future campaigns. So right when you go to our homepage, hold on one second. Hopefully now you can see my screen. Amanda just informed me that you could not see my screen. So hopefully Amanda will come in and just let me know if you can see that now. Again, on our home screen, you'll actually see down towards the middle of the screen, you'll have some upcoming webinars as well as some archives of our past webinars. Good. I got the thumbs up, so it seems like you can see my screen now. So here we have Chris's webinar. So if you wanted to replay Chris's webinar, you can do that down below. Next month, you're going to hear from Senior Advisor David Giuliano about Social Security and claiming strategies. Once again, if you want to register for those, you just click on the link right below it. You'll also notice that we have a cool new widget on the top right-hand side here. It says Crash Test Your Portfolio Right Now. It allows anyone to find out what their portfolio risk score is. So this pertains to Chris's presentation about risk, and it's something that we do for each of our clients. For those guests that want to try it out, they can go ahead and enter their portfolio information, and it will actually arrive at a portfolio risk score. Pretty cool tool. It's offered by Rick Streamer that we've used for probably the last 3 years now. So let's change gears and focus on the subject today, which is nursing home protections and what you can do to protect your assets. There are 3 available options to help pay for nursing home care. The first one, which is probably pretty obvious, is to privately pay for your own care using your own assets and or income. Now, the benefit here is that you have freedom of choice. You can go to any facility that you obviously can get into because you're a private paying individual. The downside is that you have to use your income towards your own care, and you will also need to spend down your assets if your own income is not enough to cover the cost. As I've said in our opening video that announced this presentation, in Massachusetts, I think you're looking at around $12,000 to $14,000 per month for nursing home care. So as you can imagine, you can burn through assets rather quickly. The second way to pay for nursing home care is to utilize long-term care insurance. Long-term care insurance is something that we've been helping our clients purchase for, I don't know, maybe the last 20 years. It is a very helpful tool if and when somebody does go into a nursing home, and the primary reason for that is because you're putting the onerous on the insurance company to pay for at least a portion of your care. Typically, when you purchase these policies, you're purchasing an amount that you want to receive each day in the event that you were sick and needed care. And you want to also identify how long you want that benefit to be paid. So for example, you might get a policy that pays $350 a day for up to 5 years. So if the nursing home costs $400 a day, you still have to use some of your own private assets, but at least for the next 5 years, you've got some assistance here with the long-term care insurance policy helping foot most of the bill. Again, it depends on the terms of the policy and how much you spend for premiums. These are not inexpensive policies. I would say the typical is around $4,000 to $5,000 per person. So for a family, you're probably looking at about $8,000 to $10,000. And the downside as well, beyond the premium, is that those premiums are not necessarily locked in. They can and do vary as time goes on, and usually they only vary in one direction, and that's up. Don't forget, they're trying to estimate what nursing homes and medical care is going to cost 30 years into the future, and that's a tough challenge. The third option to pay for nursing home care is Medicaid, which is really the subject today that I'm going to spend most of my time on. In terms of how to protect assets, I think the two primary ones are long-term care insurance and Medicaid planning. But again, today I'm just going to focus on Medicaid planning. Here in Massachusetts, we call Medicaid planning, or Medicaid, we call it Mass Health. So if somebody hears the word Mass Health, just know that that's what they're talking about is Medicaid. I think we've got all these words just to add confusion, as if this is not already a confusing enough subject. So Medicaid is a joint venture between the federal government and the states. Because it's a joint venture, the federal government has given the states some leeway in terms of eligibility requirements and what we'll later learn about estate recovery. So the states do have some discretion as to how they handle this program. Unfortunately, that makes it pretty challenging to make broad sweeping statements about how you do Medicaid planning, because it really is state specific. What Medicaid provides for is they make resources available to families and individuals with limited resources. And once again, they have a bunch of eligibility requirements, which we're going to dive into. Before I do, I thought rather than make the disclosure page the first page, I decided to make it, the third or fourth page. So just a couple of reminders. I'm only reviewing the most popular strategies that I see or that I've read about, but I'm not obviously going over all the available strategies. There are a handful of different strategies out there. Some of them are just so limited or for just a very unique scenario, which is obviously important to that family if they meet that unique criteria, but it's not very effective for me to include that in this kind of presentation. For those that do want more information, again, I'm just trying to show you, this is one of the books that I read, How to Protect Your Family's Assets from Devastating Nursing Home Costs. Let's see here, it's about $25 on Kindle, or if you purchase it on your Kindle. It's a good read. It does have quite a bit of technical stuff in there, but he does a good job of including examples in there, and I like examples. I think they help get the point across. As I already referenced, some strategies are not effective in certain states. Today I'm going to be focusing on the strategies that are available in Massachusetts. So unfortunately, that means if you live in New Hampshire or California or Arizona, some of the strategies that I'm going to talk about today may or may not work in that state. It's important, once again, because you're dealing with large dollar amounts in many of these scenarios. It's important that you work with a qualified consultant, and at least around here we call them elder law attorneys. These are the attorneys that really specialize in helping elders plan for these scenarios. Another reminder, nothing I'm going to go over today is a recommendation for you. I'm just sharing information. Really, recommendations on this subject should come from an elder law attorney, an accountant, and a financial advisor, all working together, because it's a multifaceted process. If you plan for Medicaid, while there might be some benefits under the Medicaid strategies, you might be jeopardizing or not so happy with some of the impacts that it has on your income taxes and or your estate plan. So let's dive into Medicaid eligibility requirements. There's really two primary areas. The first is income. Income requirements does vary between states, but the general rule of thumb is that as long as the nursing home expense exceeds your income, then you should qualify or meet the eligibility requirements for the income category. The second one has to do with assets, and this is the one that is a stumbling block for many, and quite honestly where more of the strategies lie. In 2017, the Medicaid applicant, the person that's going into the nursing home that is hoping to qualify for Medicaid benefits, is only allowed to have $2,000 of assets, to keep $2,000 of assets. If they have more than $2,000 of assets, then they are no longer eligible, or they're not eligible for Medicaid benefits. So it must be under $2,000, and they're strict about that. The healthy spouse is allowed to keep $120,900. Just to let you know, there are some quirky calculations, so you can run into some scenarios where somebody says, well, wait a minute, I'm not able to keep $120,900. And that is true. There are some quirky calculations for people that fall in certain asset brackets. So I'm telling you what you need to keep your assets at or below, but there are fortunately some things that are excluded from that calculation. The first, and probably one of the more important ones, is the prime residence. I say usually because there are some unique scenarios where they actually do include the house, or it could jeopardize your Medicaid benefits. But for most people, their primary residence is excluded. I will go into a little bit more detail on that in a bit. We're allowed to keep one automobile, no Ferraris, please, one automobile though, prepaid funeral expenses, personal belongings, clothing, jewelry. There was a case in Massachusetts where somebody was trying to qualify for Medicaid benefits or Mass Health here in Mass, and they bought a $40,000 diamond ring. The judge said that that was not acceptable, so just be forewarned. There's a fine line with that personal belonging. And you're also allowed to keep a small amount of life insurance. So let's, again, focus on the income component, the income eligibility requirements. Really, it depends on whether you're single, widowed, or a married couple. Single and widows or widowers fall into the same category, and then the separate one is married couples. So with singles, there's really not a whole lot that you can do. The income, your income it is what it is. There's nobody that you can shift it to. It's income coming in, and you need to utilize that income for your own care. For married couples, they actually do not look at both spouses' income. They only look at the Medicaid applicant's income. The healthy spouse's income is not something that Mass Health or Medicaid looks at. And the healthy spouse who's at home is not required to use their income to pay for the nursing home spouse. So this presents an opportunity. If the healthy spouse is allowed to keep their income and they don't need to, it doesn't show up on the application and it doesn't need to be utilized to pay for nursing home care expenses, then one goal would be to shift your income. Now, you can't call Social Security and say, I'd like to shift my income, my Social Security benefit, to my spouse. You can't call your group that provides your pension or your retired minimum, your required minimum distribution for retirement accounts. You can't call and say, I'd like to have you make that check payable to my spouse. Not if those were your earnings, your accounts that are generating that income. That being said, I have read about some scenarios where people have rental property, and many times the Medicaid will look at who the recipient of the check, who received the check. So if you have tenants make the check payable to the healthy spouse, if you do have a rental property, then that can sometimes qualify to shift that income to the healthy spouse. Mass Health, Medicaid, they all recognize that they can't utilize the healthy spouse's assets to pay for the nursing home spouse's care. They recognize at least that the healthy spouse who's at home needs to still have some resources available. This is one of the reasons why they implemented something called the minimum spousal needs analysis. That's not supposed to be analysis, it's supposed to be allowance. So it's minimum spousal needs allowance. You're allowed to keep $2,002 in 2017. I'll go through an example later that will actually show you how the math works on that. The other thing that you can do if you're trying to meet the income requirements and you might not be happy with just the $2,002 that they're going to allow the healthy spouse to maintain, you can file for a hearing with the Medicaid department or one of their agents and plead your case as to why the healthy spouse should be allowed to keep more than $2,002. There are some situations where that is important and they are willing and able to use their discretion to make special awards or arrange special circumstances. We're going to shift gears and go over to how you qualify for under the asset requirements that we talked about earlier. Again, nursing home spouses are allowed to keep up to $2,000. Healthy spouses are allowed to keep $120,900. So if you're going to be applying for Mass Health or Medicaid, then why don't you just give away all the assets that you have above that amount? Then you can go qualify for Medicaid. Problem is they've figured that people would do that and they put in a restriction. A lot of people are familiar with this. It's called the 5-year look back. So if you transfer assets to non-spouses or in irrevocable trust, there's a trail that comes along with that for 5 years. So if you go in to apply for Mass Health or Medicaid, on the application, they're going to ask you, have you given away or transferred any money in the last 5 years? Just please note that transfers between spouses don't qualify here. You don't need to report that. But if it's to a non-spouse or an irrevocable trust, then you do need to report it if you've made that gift in the last 5 years. If you check the box yes, that you have given away something in the last 5 years, you need to tell them how much, and they will determine a penalty. The penalty in Massachusetts, they take the dollar amount of the gift and divide it by a penalty period or a penalty amount. Currently, it's around $10,000. So if you gave away $50,000 divided by $10,000, you get a 5-month penalty period. That penalty period begins when you would otherwise qualify for Medicaid benefits. They changed this. They used to calculate this different as of maybe 5 years ago, 4 years ago, and this has created a lot of confusion. Just remember that when you apply, they're going to ask you if you've made any gifts in the last 5 years. If you have, then they're going to have you wait a couple of months or even years, depending upon the size of the gift, until Mass Health or Medicaid will start paying for your care. Again, they call this the penalty period or the disqualifying transfer. And I already have it listed down there that transfers between spouses are fine, and those are not subject to the 5-year look back or the penalty period. This will come back into play when we start talking about strategies. And hence strategies for meeting asset management requirements. So for widows or singles individuals, in Massachusetts, $840,000 of equity is excluded. So if you have a house and the equity in the house is less than $840,000, it's a non-countable asset. And Mass Health, when they ask for your application, they'll simply ignore the house. If you have over that, then you could have a problem and you may need to do something about it. I've seen some where if they have more than 840, they take out a mortgage to bring down the equity. The only offsetting problem with that is then you create cash if you're going to cash out to create that mortgage. So there's a lot of issues that need to be explored. But for those people that their house is valued and the equity is less than 840, we can exclude the house. Remember, that 840 is just to apply and qualify for Mass Health or Medicaid benefits. After you qualify and they start paying for your care, it is very likely that if you're a single or a widow and there's nobody else at home, that the state is going to put a lien on that home. What that means is when that home is eventually sold, any lien holders, which just means they are owed money, need to be paid back before the proceeds are released. Some important considerations, again, since the 840 of equity is excluded, you really need to be careful for those people that want to sell the house. You're taking a non-countable asset and turning it into a countable asset, which means that you need to spend down countable assets on your own care. The other thing that is a common suggestion from attorneys is that when the single individual or the widow moves into the nursing home, somebody, that either their power of attorney or family, should file some sort of statement that says that they have every intention to return home. If they do that, that typically will prevent the state from forcing that the property be sold to help pay for that individual's care. As I said multiple times, assets for an individual, it can be no more than $2,000. So what do you do if you have more than $2,000? Well, we call this spend down. So there are certain things that you can do. Again, I will give you an example at the end, which examples work really well for me. I hope it works for you as well. But here's a listing. You can buy a new car. You can prepay funeral expenses. Home renovations are acceptable. A 60-inch TV is a common thing that people talk about. Paying off debt. And for those people that are going through crisis planning, which really means they didn't plan ahead, they found out that they're going into a nursing home, what can be done about it to try to qualify and get my assets down under $2,000? You can purchase an immediate annuity. They call it a single premium immediate annuity. We have done this for our clients in the past with the help of an attorney. And the other thing that you can do is transfer assets to a pooled trust. Both of these get rid of your assets and will help you meet the asset requirement to keep the assets under $2,000. So again, you can qualify for Medicaid benefits. Married individuals. Again, we're focusing on assets. The primary residence, irrespective of the value of the house, is excluded. So for singles, it's $840,000. For married couples, it's an unlimited amount. Assets for the nursing home spouse cannot be more than $2,000, and for the healthy spouse, $120,900. So in total, you're allowed to keep $122,900 between the two of you. Ways to spend this down for married couples is similar to the individual: buy a new car, prepay funeral expenses, home renovations, 60-inch TV. I would say plasma, but that's actually dating myself now. I guess they've got the curved TV. They're 4K now out there. You've got pay off debt. And then if you have in fact planned 5 years in advance, then you can look at some common things to look at is starting to transfer assets or gifting assets to non-spouses or an irrevocable trust. Again, that's usually a good idea to look at that if you know that you have excess assets beyond what you need to satisfy all your goals. So if somebody's goal is to have their portfolio outlast them, they need their portfolio to be there for them. But if they only needed $500,000 to accomplish that and they have $750,000, then they may want to look at transferring or gifting that excess beyond what they need to do to meet all of their goals, either to a non-spouse, maybe the kids, or into an irrevocable trust. One quick note on irrevocable trusts. There have been, over the last 3 years, more critiques by Mass Health in particular about irrevocable trust. They're sort of poking holes. They're having problems with it. They're not winning all of these things, but they are definitely snooping around the irrevocable trust side. So I think what that means is you probably want to visit with your attorney a little bit more frequent if you're using the irrevocable trust or irrevocable trust avenue, just to make sure that the attorney is informing you about any kind of recent changes to make sure that your strategy is still on track. Some crisis planning for married individuals or married families is for the healthy spouse to actually purchase an annuity. We talked about that for singles, where we called it the immediate annuity or single premium immediate annuity. Well, remember, healthy spouses are allowed to keep their income. The healthy spouse is the spouse that's at home. They're allowed to keep their income. So one option is, how do you convert assets into income? How do you take $100,000 of money at the bank and turn it into income? You can purchase an annuity, and it's a certain type of annuity called a single premium immediate annuity. And what that does is it will turn that lump sum into cash flow, money coming in each month. And if done properly, then the healthy spouse is the recipient of that, and they're allowed to keep that, and they do not need to utilize those funds to pay for the person that's in the nursing home. You can also schedule a hearing with Medicaid as well to plead your case as to why you should be allowed to keep more than $122,900. Maybe you have rental property that is important for the healthy spouse to receive the income so that he or she can live their life. Maybe you've got a business and you need certain operating accounts to be able to keep that business afloat or meet payroll. So there are certain things that and reasons why you may want to actually meet with Medicaid to plead your case as to why they should allow you to keep more than these designated amounts. Some other considerations: healthy spouses should update their beneficiaries and accounts, beneficiaries on accounts, life insurance, and in their wills. What you usually do not want to have happen is the healthy spouse leaving their estate plans or beneficiary designations untouched. If that healthy spouse passes away, those assets are going to float over to the person in the nursing home, and that's going to disqualify them for Medicaid benefits, and they'll be required to spend down those assets. The other thing that's available is what's called testamentary trusts. It's actually a federal rule, so this one is uniform across all states, that if in your will you leave your assets to a trust that benefits your spouse, that trust is exempt from Medicaid, and they cannot recoup or go after or count those assets. So you qualified for Medicaid benefits. They've been paying for your care, and something that you need to be familiar with is that Medicaid has required the states to try to recoup their expenses. As you can imagine, this is a very expensive proposition that Medicaid has accepted, and one of their responsibilities, according to the federal government, is that they put procedures in place for what we call estate recovery, where they will try to recoup their costs. I think probably the primary way that this is done is with the house, because quite honestly, for a Medicaid applicant or beneficiary to be receiving benefits, they can only have less than $2,000 of assets besides the non-countable assets. So you're really looking at the house. And that's one of the reasons that most of the conversations that have to do with Medicaid recovery tie into the house. Well, from our point of view, we're looking to see if we can identify ways to protect the house so that Mass Health or Medicaid does not go after it. Now, in certain states, this is easier than other states. Fortunately, right now, Massachusetts is one of the easier states to do this. They've had conversations. They actually passed a law that said that they were going to make it more difficult, but then in practice, when they tried to actually do it, it was very cumbersome, and the administrative requirements and work didn't justify what they were actually recovering. So they actually scrapped it. It's been talked about again, but so far we have not seen anything passed. So in Massachusetts, what they use is any of the Medicaid recipients' assets that go through probate. Probate is just when you pass away, if they have to read your will to find out who you want your assets to go to, then they have to open up probate, and that is the probate process. So anytime they need to read your will to identify what asset needs to, how it should be distributed, that asset is at risk of being recovered by the state or Medicaid. One of the things to keep in mind to avoid probate, a lot of people talk about probate and a lot of people want to avoid it. It's not quite as bad as it used to be in Massachusetts, but for a lot of people, they do want to avoid it. A lot of people use revocable trusts to avoid probate. Also, if you have beneficiary designations on accounts or you own accounts joint with rights of survivorship, then those two will avoid probate. And this is sort of segue into, hey, if we can avoid probate in Massachusetts, then those assets most likely will not be attempted to be recovered by the state of Mass or Mass Health. Let's go through some strategies. So for single or widow, what we're looking at for the prime residence is don't own the property in the Medicaid recipient's name. Try to change that. Now, it's easier said than done, but we can certainly look at some examples. One exemption is to have a child live and care for you in your home, keeping you out of the nursing home for at least 2 years, and you're allowed to transfer that home to that child. It's like a free pass that Medicaid has offered because your child is helping to keep you out of the nursing home system, hence saving them money, so they allow you to transfer the home as sort of a thank you. There is no penalty period, and this is not something that's subject to the 5-year look back. Another thing to consider is that if the property is owned by the person in the nursing home, they're already in the nursing home, they've been there for a while, the state might already have put a lien on the property. One of the things that you might want to do is rent the property, because remember, any income that you can bring in helps reduce the amount of money that Mass Health or Medicaid is paying for your care. Hence, when they recover their expenses that they paid for you, they will recover less because you use the rental income to reduce their expenses. Another exemption, I referenced it up above with the child living with you for 2 years. The other thing you can do is make sure that you have a long-term care policy that has a $125 daily benefit for at least 2 years. That provides an automatic exemption where the state will not go after your house. If you had the luxury of planning for this in advance, you need 5 years to plan for this so that you don't have to be subject to the 5-year look back and penalty period. Then one of the things that we suggest people look at is transferring or gifting their home to their heirs while they retain a life estate. A life estate just means that you can stay in that house for the rest of your life and nobody can kick you out. So your children own the property if they're your heir, but even if your children were to get sued or divorced, the creditor or the ex-spouse, they can't really do anything about it because there is a life estate on the property and you have the legal right to stay in that property. The next is irrevocable trust is another option. There's not much else you can do, remember, because singles are only allowed to keep $2,000 of assets. So in terms of trying to reduce estate recovery on the $2,000, there's not a whole lot that you can do. For married individuals or married couples, the primary residence, one of the things that you want to do before the sick spouse goes into the nursing home, if possible, is to transfer the property to the healthy person's name. Again, you want to start to shift those assets. This will help reduce estate recovery because if the property is in the healthy spouse's name, when the person in the nursing home passes away, the property does not pass through probate. Now, remember I said certain states don't just restrict this to probated assets. So again, this strategy works very well in Massachusetts. It does not work well in other states that have an expanded definition of assets that they're going to recover their expenses from. Here in Mass, it's probated assets. In some other states, they include probated assets and non-probated assets, in which case they probably would go after the house when the healthy spouse passes away. I've read a lot about this, and I've never seen a scenario where, as long as there's a healthy spouse, even in a state that has an expanded definition of assets that they'll go after, we've never seen them actually go after those assets while the healthy spouse is still living and using the house. But certain states are going after that house when the healthy spouse passes away. So the same concept for other assets, bank accounts, go ahead and transfer those if possible to the healthy spouse as well for similar reasons. The other thing I referenced in both of these, it is very important that you consider updating beneficiaries, change joint accounts to individual accounts, and update your will. At least for the healthy spouse, because you just want to make sure that you don't accidentally leave all of your assets to the person that's in the nursing home. We're going to go through two examples. We're at about 35 minutes so far, so hopefully this will take maybe another 5 minutes or so. So we've got Sheila Robinson. She's a widow, 80 years of age. She's got 2 kids, and she lives in Massachusetts, and she's relatively healthy. Her income is a total of $2,700 between Social Security and pension. And for assets, she has her forever home that's valued at about $500,000, bank accounts at about $250,000, and she has a Toyota Avalon with a Kelley Blue Book of $25,000. Now, I put in parentheses there, or quotes, forever. One of the things that I often ask my clients is, when you found your forever home, when you found that home that you have no intention of ever leaving, let us know, because that's when you may want to start giving consideration to putting those homes into an irrevocable trust or giving it to the kids and maintaining a life estate to get that 5-year clock started. When Sheila's 80, she does that. She takes our advice. She gives the property to her 2 kids to avoid estate recovery. She maintains a life estate. Because that is still a gift, you have to file a gift tax return. It doesn't necessarily mean that taxes will be owed. For most people, they won't. But there is a gift of $281,000. That is something that would be subject to the 5-year look back. So you need to get through those 5 years. Otherwise, they could come back to bite you with a penalty period. And she is not interested in gifting any bank assets. The only thing she wants to do is just gift the house. So 5 years later, Sheila has a stroke and she needs to go into a nursing home. Her pension of $2,700, for all intents and purposes, is going to go straight towards the nursing home. But again, what if the cost is $10,000, $12,000, $14,000? That's not going to go a long way. For assets, 5 years later, she's, instead of $250,000, she's now got $200,000. She's only allowed to have $2,000, so she's got excess here of $198,000. So she needs to start looking at some asset spend down strategies. So her house, the septic is old and needs to be replaced, so she does that. That's $30,000. She purchases a car. She trades in her old Avalon for a new one, has a net out-of-pocket expense of $20,000. And it can't just be a car that's sitting around. You really have to justify, hey, you know, the kids are going to use this to come visit or take me to doctor's appointments. Purchase that $1,000 new TV, prepay some funeral expenses, and this has just reduced your assets by $56,000. That's what all of those amount to, leaving $142,000 that you still have above Medicaid eligibility requirements. So you still have too much in assets. Medicaid application, remember the primary residence, it's only $500,000, so it's non-countable. There's a life estate. She gifted this 5 years ago, so we have no penalties. We don't have to even worry about the house at all in this scenario. Her income needs to go towards her care, and because she has $142,000 more than she's allowed to have, she is ineligible for Medicaid benefits for a period of 14 months, or a little over a year, before those assets are exhausted. The benefits here is after is that she's able to pass on her house, which was about a $500,000 account. She's able to shelter about $56,000 by spending down those assets on home improvements, which should actually increase the value of the house as well. And just remember that homes and cars, as long as they're jointly owned, will not go through probate, and hence no estate recovery in Massachusetts. So in this scenario, Sheila was able to successfully save about $556,000. She did have to spend assets, as you most usually do, but she was successful at saving some of and protecting some of her assets. Got one more example for you. John and Jane Otesta. Happily married for 55 years, 3 kids, ages 82 and 80. John's health is failing and Jane can no longer take care of him. John is preparing to enter a nursing home, and we call this crisis planning because they did not do any plan in advance, really the 5 years before. John's income is a total of about $4,700 and Jane's is $1,250. For assets, they have $700,000 jointly owned. They are in Massachusetts. They have bank accounts at $400,000 owned jointly, and there's something about that Avalon. It seems to be a pretty popular car at $10,000. Their estate plan is sweetheart wills, which just means they leave everything to each other and then their children. So one of the things that they want to consider is to transfer the house to Jane, the healthy spouse, using her durable power of attorney. Now remember, if John is incapacitated, he can't make these kind of financial decisions on his own. The document that you need to sign to allow Jane to do this in advance of him getting sick is a durable power of attorney. This is typically part of a standard estate planning package that attorneys put together for you. Change bank account owners to Jane. Again, she would need to just change this from a joint account to an individual account. Again, she would use her durable power of attorney. Jane wants to definitely meet with her attorney to update her will to change her primary beneficiary from her husband to her 3 kids. So for assets, they have $400,000 minus the $2,000 that John is allowed to keep, minus the $120,900 that Jane's allowed to keep. So this means they have excess assets of $277,100. So let's go through the asset spend down. They need to upgrade the heating system, put in on a new roof. Again, another new car. Guess what kind of car they got. The $1,000 new TV and the $10,000 prepaid funeral expenses. So you're able to get the excess assets down to $221,000 above what Medicaid says you're allowed to have. So the new excess of $221,000, one of the things that you can give consideration to is a gift and an annuity. There are specific, very specific formulas for this. They more often call this half a loaf with an annuity. And what you do in this scenario is, based on the formulas, in this example, we're able to gift, Jane is able to gift $121,000 to her kids. She could also do this to a trust if she wanted to. This subjects her, or John actually, to 13 months of a penalty period that he's not eligible for Medicaid or Mass Health benefits. What she does with the other $100,000 is she turns that asset into income by purchasing a single premium immediate annuity. This will generate approximately $600 a month for her. So what we did was we took $400,000, we reduced it by $221,000, which is the gift and the annuity, and we also reduced it by the spending down, purchasing things, and improving the house. So this leaves them with $122,900, which, by the way, is the amount that married couples are allowed to have in assets in order to qualify for Medicaid benefits. So now, after they purchase the annuity, they apply for Medicaid. The house is non-countable because they're married and it's an infinite amount. The penalty period is 13 months, so Jane has to use the family's assets and their income to privately pay for 13 months. After 13 months, Medicaid benefits will begin. Remember, there is a minimum spousal needs allowance, which I had analysis earlier, so it is allowance of $2,002. So Jane receives her $1,250 of Social Security plus $600 from the annuity, so she's also allowed to keep another $152 from John's income. And remember, Jane does not need to use any of this income for John's care. The balance of John's income will go to the nursing home. But in the scenario, we were able to protect $277,000 through the gifts of $121,000, which went into the annuity of $100,000, and the spend down of $56,000. This is all utilizing available strategies that are available today in Massachusetts. And remember, the home was protected from estate recovery since it will not pass through John's probate, which could potentially protect another $700,000. I say potentially because we don't know what's going to happen with Jane and what her health will bring. But in this scenario, you can see from both scenarios that we're able to shelter a good amount. In case anybody wanted to know that my wife has an appointment with the dog later. The second disclosure, again, I'll just reference that we did not analyze all of the available strategies during our discussion today. There are still legal ways to protect your family's assets. Please remember that nothing we discussed today is a recommendation for you and your family. Recommendations pertaining to this subject matter should come from a qualified elder law attorney who specializes in this area. The rules and regulations truly are too fluid to rely on anyone not qualified to give this kind of advice. Also remember that certain Medicaid planning strategies may work counter to estate planning and or income goals. These need to be considered in the totality of the decision-making process. My goal here is to just get the conversation to help you when the time comes to be familiar with some of these strategies so it's not the first time that you're hearing these. What I'd like to do is to take a couple minutes and just open this up if there are any questions. So Amanda will most likely jump on the line with us and let us know if there are any.
Hi, Jamie. Just a reminder to everybody, you can use the chat or the question box on your taskbar to reach us with any of your questions. Jamie, we do have a couple. The first one is, you mentioned testamentary trusts earlier. Can you explain what those are?
Yep. Testamentary just means that it's a trust that you create in your will. That's it. So, I have my standard will, and in there I say, upon my death, I want to create the Jamie Upson Testamentary Trust. And then I describe what I want those terms in the trust to be. As long as you do that, you could actually leave your spouse assets. By the nature of having to look at your will, you have to go through probate, which scares a lot of people. I don't think it's quite as scary as it used to be, so that's maybe something that may grow in popularity as people become more comfortable with the word probate. But as long as you allow your assets to go through probate to benefit your spouse, then those assets that went through the probate process and are sitting in the trust are sheltered from Mass Health or Medicaid, so they cannot go after them and they turn a blind eye to them. It's something that I think we'll see growing in popularity. I actually was just only exposed to this about a month ago when I had some clients that said that their attorney had just drafted this, and I did some research on it, and lo and behold, I found that it was something that was accepted at the federal level as an exemption.
We do have another one. It says, my mother is in a nursing home collecting Medicaid benefits. We just found out that she is going to inherit $50,000 from her brother who recently passed away. Will this disqualify her from the Medicaid benefits?
Yeah, that's a good question. Yeah, there is a rule in Massachusetts that says that if you're the beneficiary of and you're about to inherit something, normally you can disclaim it. They call it disclaiming, meaning that you say, no, I don't want to receive that inheritance. I'd rather pass on it. But because Mass Health is on the hook for your expenses, or they're paying your expenses, they override that and say that if you're entitled to a benefit, to an inheritance, you must receive it. You cannot give it up. So you have to take that $50,000 in. Now, you got a couple choices. One choice is you would become disqualified for Medicaid benefits, and you would have to start spending down that $50,000 until your assets got below $2,000, in which case you could then qualify again. Another option Actually, I guess there's two. You could purchase a single premium immediate annuity because that would get rid of the asset and it would turn it into an income. Again, all of this money is still going to go to the nursing home primarily or reimbursement to Mass Health or Medicaid. But if your goal is to stay on Medicaid and not lose benefits, then yeah, an immediate annuity should work. And the final one that I did reference, and I also referenced it in my white paper that you can also find on our website. It's a white paper. It's about 6 pages long where I put even more details about this subject matter together. But they call it a pooled trust, so that if you do receive or have any money and you are okay putting and really giving up those assets, you can put it into a pooled trust that is managed with other people who pool their money together. They do account for them separately so you can see how much money you put into it. And you are allowed to use those assets for personal things like getting your hair cut or going out to eat with, or clothing, things like that. But then when you pass away, the money's going to be turned over. It's almost like a charitable contribution. And I believe they keep it in the trust or blend it with the other trust and still make that available. I'm not entirely sure what they do with it after, but for all intents and purposes, that would be another way that would help you qualify for Medicaid or stay qualified for Medicaid benefits. Any other questions, Amanda?
Jamie, no, I think that's it. But if anyone here on the webinar today does have any questions, just please feel free to call the office or to email myself or Jamie, and we can make sure to get back to you with a more personalized answer.
Great. Excellent. Thank you, everyone, for joining us. This is recorded, so we'll be replaying it on the website soon if you wanted to review it again. Thank you again. Bye-bye.